Today in this session, we are going to discuss a very important topic of financial management called investment decisions. In the previous unit number 1, we have discussed the important financial decisions are investment decisions, financing decisions, working capital decisions, and dividend decisions. Out of these, investment decisions are very critical. The financial management focuses not only on procurement of funds, but also on effective utilization of funds in order to achieve the objectives of the financial management, that is maximizing the wealth of shareholders. So allocation of fund is a very important function of financial management. The allocation of funds refers to the commitment of funds on assets and activities. In other words, we can say the allocation of funds refers to the investment in assets. Broadly, we divide the assets into two categories: short-term assets or current assets, and long-term assets or fixed assets. So the investment decisions in short-term assets are called management of current assets or working capital management. This topic we'll discuss in the next unit. But in this unit, we are going to discuss about the investment decisions of long-term assets or fixed assets. The decision process of long-term fixed assets are called capital budgeting. So capital budgeting refers to the process of generating, evaluating, selecting, and following up of capital expenditure alternatives. So before discussing about capital budgeting, we discuss about capital expenditure. So capital expenditure is that expenditure whose benefit will accrue to the business over a long period of time. Example of capital expenditure is purchasing a machine, purchasing a plant, purchasing a building, setting up of a factory, setting up of a branch, increasing the capacities, where investments have to be made now, but benefit will accrue over a long period of time. These are called capital projects, and the expenditure is called capital expenditure. So here, the capital budgeting decisions are very critical and crucial from the point of view of management, because the long-term destiny of the company depends on this type of decisions. If an appropriate capital budgeting decision is taken, then definitely it will bring spectacular returns to the company in the long run. But if an inappropriate or incorrect investment decision is taken, it will completely ruin, it will completely destroy the survival of the business. The business cannot survive in the long run if a wrong investment decision is taken. So this is of paramount importance, this type of decisions. Only top management, after making a lot of planning, then only they will take up this type of decisions. So simple words, capital budgeting decisions are those decisions which are concerned with whether to acquire a capital asset or not. A number of tools and techniques are available in the hands of finance manager to evaluate these decisions, to evaluate these type of decisions. So the characteristic features of these strategic decisions or capital budgeting decisions are: the first one is substantial expenditure. Normally, the amount of expenditure required in capital project is so huge that easily we cannot take the decision. If the amount is small, routine decision we can take. Just like in our personal life. जब पर्सनल लाइफ में कोई चीज़ अगर खरीदते हैं, छोटा अमाउंट रहता है तो हम ज़्यादा नहीं सोचते हैं. कोई बड़ी चीज़ अगर खरीदना है तो वी हैव टू थिंक फ्रॉम डिफरेंट एंगल्स. Just like day-to-day groceries we purchase, we won't think much. We'll take randomly easy decision. But when we have to purchase an asset, like we want to purchase a car, we want to purchase an LCD, we want to purchase a refrigerator, we'll think a lot because the amount involved is more. Similarly, in a business organization, the amount required for capital project is huge. So before investing the money, we have to think a lot. So first feature of this capital budgeting decision is huge amount is required, substantial expenditure is required. Secondly, second feature is long time period. Normally this capital budgeting decision is that decision where the investment is made now, but the benefit will accrue over a long period of time. And future is completely uncertain. So we have to make a forecast how much gain we can get in future. We have to make an estimation. So long-term consequences will be there in this type of decisions. Next is irreversibility. Once a decision is taken, it will be very difficult to reverse it. एक बार डिसीजन ले लिए तो उसको रिवर्स नहीं कर सकते, अगर करे भी तो you have to incur a lot of financial loss. Simple example in our personal life. Without thinking, अगर एक कार खरीदना है तो बगैर सोचे समझे कार ले लिए, लेने के बाद पता चला हम ये कार नहीं खरीदना चाहिए था. This is not suitable for our purpose. Family members हमारे पास घर में 6 है, जबकि कार की कैपेसिटी 4 ही है, 4-5 है, तो it will be difficult for them. In this way, before purchasing the car, we must evaluate from different angles. We should not purchase in hurry. Otherwise, what will happen? There is no second-hand market. If there is second-hand market, we won't get the price. We'll incur loss. तो यहाँ पर भी irreversibility का मतलब once a decision is taken, we cannot reverse the decision. We cannot change the decision. Next one is complex decision. This type of capital budgeting decisions are very complicated, complex. The reason is we have to compare the cost and benefit. The cost is incurred now, but the benefit will accrue in future for a long period of time, like 10 years, 15 years. It's very difficult to estimate the forecasting to make for the next 15 years because the economy, the environment is changing. So many changes are taking place in the environment, in the market, in the business organization. Competition is there. Government laws are changing. So all these things will make things more complicated. We cannot easily forecast or estimate. So that's why these decisions are very complex decisions. तो ये decisions जो होती हैं capital budgeting decisions, only top management they have to take after making lot of calculations, lot of deliberations. Then only they can make, because in hurry we cannot take this type of decisions. Now investment decision process. So far we have discussed the introduction of investment decision and what are the features of this investment decision. Now investment decision process. Actually this capital budgeting process is a very complicated process which involves a number of steps to be taken. The first step of this investment decision process is planning. Planning in the sense evaluating what are the potential opportunities available for investment. So the top management will get the idea. They have to decide what are the opportunities available where we can be able to invest the money, where we can have good potential opportunities available. So finding out, planning regarding what are the opportunities available. First step. Second step is evaluation. Once we have decided that there is one opportunity, there is an opportunity to make capital investment, then we have to evaluate. Evaluate in the sense we have to collect the data regarding that opportunity of investment. Collecting the data, how much cash is required for investment and how much inflow we can expect, how long we can expect. This is nothing but evaluation stage. Next is selection. Once we have decided, now we select. because we have different alternatives of that investment. एग्जाम्पल, एक मशीन खरीदना है, मशीन खरीदने के लिए पहले ये डिसाइड कर लिए कि मशीन खरीदने से बिजनेस को प्रॉफिटेबिलिटी बढ़ेगी. सेकेंडली हम इवेल्युएट कर लिए मशीन के लिए कितना पैसा चाहिए, डाटा सेलेक्ट कर लिए. नाउ वी हैव टू सेलेक्ट फ्रॉम विच सप्लायर वी कैन परचेज द मशीन. देयर आर डिफरेंट suppliers alternatives available. Selecting that supplier which which will be consistent with our objective. Next is implementation. Once selection is done, now we have to procure the funds and make the investment. Put that project in the implementation stage. Then next one is control. Time to time we should get the progress report card of the project. By taking the feedback, taking the feedback, we can be able to get the progress report of this project. Last one is review. On the completion of the project or just before completion, we want to see whether we are successful in achieving our objectives, whether we are successful in getting the benefit of this project or not. This is the last stage of investment decision process. Now the next topic we discuss is developing cash flows for projects. See, every project involves cash flows. Cash flows means the inflow as well as outflow. जो पैसा आ रहा है वो इनफ्लो है और जो पैसा जा रहा है वो आउटफ्लो है. तो कैश फ्लोज डिटरमाइन करना that is most important in capital budgeting decisions. First of all, we have initial investment. The capital expenditure required in the beginning when T is equal to 0, that is the cost of the project, is called initial investment. This is the cash outflow. Not only the cost of the project but also the incidental expenditure like freight, insurance, installation, all these things will be added to the cost. It will be a part of initial investment. And some projects required some permanent working capital also. That will also be added to the initial investment. So initial investment is the total cash outflow at the beginning of the project. Next comes operating cash flows. The annual cash inflows generated after making the investment are called operating cash flows. For example, a machine's life is 10 years. So first we have to make cash outflow on purchasing the asset. After purchasing the asset for next 10 years, we'll get the inflow. That is called operating cash flows. Last one is terminal cash flow. The terminal cash flow will arise on the expiry of the life of the asset. Suppose the life of the asset is 10 years. At the end of 10 years, we'll get the scrap value or salvage value. And also if there is permanent working capital applied, that permanent working capital will be released. And these are called terminal cash flows. So in this case, the first initial investment is cash outflow, whereas operating cash flows and terminal cash flows are the inflows. So any investment, any capital budgeting proposal, it is required to find out all the cash flows, how much outflow and how much will be the inflows. Next topic is conventional and non-conventional cash flows. So cash flows can be broadly divided into two categories called conventional and non-conventional. In conventional cash flows, there is a cash outflow in the first case. In the beginning, we have to make a cash outflow. Once we make a cash outflow, in future continuously we'll get the inflow. The outflow takes place only once, whereas inflow will get regularly every year. This is called conventional. That means outflow, after making cash outflow, it will be followed by inflows. Next is non-conventional cash inflows. In non-conventional cash flows, we don't have a single outflow. We'll make one cash outflow now, then we'll get the inflow for the first 2-3 years. Then after 2-3 years, again we have to make some cash outflow, then we'll get some inflow. 2-3 years. Then after that again we have to make some cash outflow. So regularly there are cash outflows and also cash inflows. That is called non-conventional cash flows. Now we discuss about measuring future benefits. Measuring future benefits. When in any decision, when a decision is taken to purchase anything, we compare two factors, that is cost and benefit. Cost and benefit. In capital budgeting, cost is certain, but benefit is uncertain. We'll get the benefit in future. So we have to evaluate, we have to calculate how much benefit we can get. So there are two criteria of calculating the future benefit. One criteria is accounting profit, and the second criteria is cash flow. The accounting profit is the net profit, profit after tax, which we get in P&L account, profit and loss account. After charging all expenses, we get net profit. That net profit after charging tax also, that is called accounting profit. The second is cash flow. Now, how to distinguish, what is the difference between this accounting profit and cash flow? In accounting profit, while calculating accounting profit, we take all expenses, whether it is cash expense or non-cash expense. Every type of expense we take into account for calculating accounting profit. But for calculating cash flow, we should not take the non-cash items. We take only cash inflows and cash outflows. So in this cash flow method, we take accounting profit. To this accounting profit, we add back the non-cash items which are already charged in calculating accounting profit. Example, depreciation is the classic example. Depreciation is a non-cash expense. It was debited to P&L account. By debiting to P&L account, our profit has come down. But depreciation is a judgmental item. There is no cash outflow in case of depreciation. It's a policy matter, accounting policy. So different businesses they'll apply different accounting policies, different methods of depreciation. By charging different depreciation, the profitability will change. So profitability depends on depreciation and other amortized items or inventory valuation policy. So a number of judgmental policies, accounting policies are applied on account of some items like inventory valuation, depreciation, and allocation of cost or amortization of intangible assets. These are the items which require policy, judgment. By removing all these policy items, we take only cash inflow and cash outflow. That method is called cash flow. So comparatively, accounting profit and cash flow is much superior to accounting profit because the ambiguities of accounting policies will not be there in case of cash flow. We take only cash items of incomes and cash items of expenses. So in all the tools and techniques, we apply this cash flow technique. Only in one method we apply accounting profit, that is average rate of return. In that case, we apply accounting profit. All other criteria we apply cash flow technique. Techniques of evaluation of capital budgeting proposals. कैपिटल बजटिंग जो प्रपोजल है उसको इवैल्यूएट करने के लिए टेक्निक्स कौन से अवेलेबल है. ब्रॉडली देयर आर टू टेक्निक्स ऑफ इवैल्यूएटिंग कैपिटल बजटिंग प्रपोजल्स. द फर्स्ट इज ट्रेडिशनल टेक्निक और अनडिस्काउंटेड टेक्निक और unsophisticated techniques. Second one is modern techniques or discounted techniques. So under first category, traditional techniques, we have two methods. The first is payback period method, PBP. And the second method is average rate of return or accounting rate of return, that is ARR. These two are the techniques of evaluating the capital budgeting proposal.